Did you know that financial experts might be holding back some crucial truths? In this video, we'll explore the money secrets financial gurus don't want you to know. We'll uncover why one-size-fits-all financial advice often misses the mark, explain why time is so crucial for investing success, and point out the red flags in guarantees and forecasts. We'll also look at how social media influences your finances, the difference between trading and investing, and what it really means to achieve financial independence. Stick around until the end to find out these key insights and learn how to use them to improve your financial situation. If you enjoy the content, give Luxo-Life a thumbs up and let's begin. Why one-size-fits-all financial advice doesn't work. Let's begin by saying that there is no universal solution in personal finance and investing. Each person's financial situation is unique, and what works for one individual might not work for another. This means that a financial strategy that's successful for one person could be ineffective or even harmful for someone else. It's important to recognize that there's no single formula that will guarantee success for everyone. Different people come to different conclusions about how to manage their money because their circumstances, goals, and values vary. For example, one person might prioritize saving for a down payment on a house, while another might focus on investing for retirement. These different priorities lead to different financial strategies, and that's perfectly okay. What's crucial is finding an approach that aligns with your own goals and needs. Understanding that there is no one-size-fits-all answer helps you make more informed decisions. Rather than following generic advice, it's better to tailor your financial strategy to your personal situation. Take the time to assess your own goals, risk tolerance, and financial landscape. This personalized approach is more likely to help you achieve your objectives and navigate your financial journey successfully. How time affects your investing success. Time is indeed gold, especially when it comes to investing. One of the most important factors for successful investing is patience. The longer you can keep your money invested, the more likely you are to see significant growth. This is because investments typically increase in value over time, and the longer they are allowed to grow, the more potential they have to deliver strong returns. Think of investing like planting an oak tree. When you plant an oak, it doesn't grow onto a towering tree overnight. It takes many years, even decades, to reach its full height. Similarly, your investments need time to grow and mature. If you're constantly pulling money out or getting impatient, it's like trying to pull the oak tree out of the ground before it has a chance to develop. The growth might be slow at first, but with time, it can become something truly impressive. Understanding the role of time in investing helps you stay focused on your long-term goals. Rather than worrying about short-term fluctuations or trying to time the market, you can let your investments benefit from the power of compounding. The idea is to give your money the time it needs to grow, just like giving that oak tree the time to become strong and robust. Red flags. Why guarantees and forecasts can mislead you. When it's too good to be true, it's definitely worth taking a closer look. Financial guarantees and high-confidence forecasts often come with red flags. No one can predict the future with absolute certainty, especially in the world of finance. If someone is promising guaranteed returns or making overly confident predictions, it's a sign to be cautious. These promises can sometimes be more about attracting your attention than delivering real results. The problem with guarantees and forecasts is that they are often based on incomplete information or overly optimistic assumptions. The finance markets are unpredictable, and claiming to have a crystal ball can be misleading. For instance, a forecast might suggest that a certain investment will perform exceptionally well, but it doesn't account for all potential risks and changes in market conditions. This can lead to unrealistic expectations and financial disappointment. Another issue to consider is the incentives behind financial advice. Financial advisors and firms may have a vested interest in promoting certain products or strategies because they earn commissions or fees. This can create conflicts of interest, where the advice you receive is more about benefiting the advisor then helping you achieve your financial goals. It's important to recognize that not all advice is unbiased and to question the motives behind it. The power of learning from financial mistakes. Past mistakes are meant to guide you. That's why learning from financial mistakes is crucial for growth and improvement in your investment journey. Each mistake, whether big or small, offers a valuable lesson. By reflecting on what went wrong and understanding why, you can make better decisions in the future. Being open to adjusting your strategies based on these lessons can lead to more successful investments over time. Change is an inevitable part of investing, and being willing to adapt is key to long-term success. Historical events like the 2008 financial crisis or the COVID-19 market downturn can dramatically shift your perspective on risk and investment strategies. These events show us how quickly the financial landscape can change and highlight the importance of flexibility and ongoing learning. Understanding how past events impact your view of risk helps you navigate future uncertainties more effectively. For example, a major market downturn might make you more cautious about high-risk investments, while past successes can boost your confidence in certain strategies. Being aware of how these experiences shape your investment approach allows you to make more informed and balanced decisions. Social media's impact on your finances, the good and the bad. Indeed, almost everything can be found on social media. That's why misinformation is a growing concern. While social media has made financial information more accessible to everyone, it also means that anyone can share their opinions, whether they are accurate or not. This democratization of information has its benefits, as it allows for a broader exchange of ideas and financial advice. However, it also opens the door to a lot of hype and misleading content. The influence of social media is evident in events like the GameStop stock surge and the rise of Dogecoin. In the GameStop case, online communities rallied to push the stock price up, driven by a mix of enthusiasm and speculative trading. This led to a massive volatility and highlighted how social media can amplify market movements, sometimes in unpredictable ways. Similarly, Dogecoin started as a joke but gained significant attention and value due to social media hype, showcasing how online platforms can drive trends. These examples underscore the double-edged nature of social media in finance. On one hand, it offers a platform for people to learn about investments and market trends quickly. On the other hand, the speed and reach of social media can also spread misinformation and create speculative bubbles. It's crucial to approach financial advice on social media with a critical eye and verify information through reliable sources. Trading versus investing. Understanding the key differences. Trading and investing are two different approaches to managing money, each with its own set of strategies and goals. Let's understand them a little more. Trading involves buying and selling assets frequently, aiming to profit from short-term market movements. This approach requires constant attention and quick decision-making, as traders often focus on short-term gains. On the other hand, investing typically means buying assets with the intention of holding them for the long term, allowing them to grow in value over time. One key difference between trading and investing is the time horizon. Traders look for opportunities to profit in the short term, which can lead to a more reactive and fast-paced approach. Investing, however, is about building wealth gradually. By choosing investments with strong fundamentals and holding them for years, investors benefit from the power of compound growth and less day-to-day market noise. This long-term strategy tends to be less stressful and can lead to more stable returns over time. Speculative trading, which involves betting on short-term price movements, can be risky and often leads to higher volatility in a portfolio. It might offer quick profits, but also comes with the potential for significant losses. Sustainable investing, on the other hand, focuses on the long-term health of investments, such as those in companies with strong financials and growth prospects. This approach tends to be more stable and less influenced by daily market fluctuations. How frugality leads to financial independence. Frugality is more than just saving money. It's a mindset that can pave the way to financial independence. By living below your means and being mindful of your spending, you can accumulate savings and investments that eventually provide financial freedom. This approach isn't about depriving yourself, but rather making thoughtful choices that prioritize long-term security over short-term gratification. When practiced consistently, frugality can help you build a strong financial foundation and achieve your goals more efficiently. One key benefit of frugality is the ability to save and invest more effectively. By reducing unnecessary expenses, you can allocate more money towards investments that grow over time. This compounding effect can significantly boost your wealth, allowing you to reach financial independence sooner. It's about finding a balance where you live comfortably but still make conscious decisions that support your long-term financial health. It's important to differentiate between retiring to a life of leisure and achieving financial independence. Retirement often implies a fixed lifestyle where you may stop working entirely and focus on leisure activities. Financial independence, however, means having the freedom to choose how you spend your time. Whether it's continuing to work in a field you're passionate about, pursuing hobbies, or simply enjoying more flexibility in your life, it's about having the control to make choices that align with your values and desires. Avoiding lifestyle inflation, keeping your spending in check. Lifestyle inflation is a concept that means as your income grows, your spending tends to increase as well. It's easy to get caught up in wanting more and more, whether it's a bigger house, a fancier car, or more luxurious vacations. While it's natural to enjoy the benefits of earning more, letting your spending rise at the same price as your income can make it harder to achieve your financial goals and lead to stress about money. When you allow your expenses to grow faster than your income, it can derail your financial plans. Instead of building savings or investing for the future, you might find yourself living paycheck to paycheck despite a higher salary. This can create a cycle where you're constantly chasing the next material upgrade, which often doesn't bring the lasting happiness you might expect. Keeping your spending in check helps you avoid this trap and ensures you stay on track with your financial objectives. One of the key benefits of controlling lifestyle inflation is that it allows you to save and invest more effectively. By maintaining a budget and not letting your spending rise with your income, you can allocate more funds towards savings and investments that will grow over time. This approach not only strengthens your financial foundation, but also provides a sense of stability and control, reducing financial stress and improving overall well-being. Why material possessions don't define success. Success is often tied to material possessions, but this connection can lead to dissatisfaction. When we measure achievements by the cars we drive, the houses we own, or the gadgets we have, we might find ourselves constantly wanting more. This pursuit of more things can create a cycle of never-ending desire, where true contentment always seems just out of reach. Linking success to material wealth can lead to a shallow sense of fulfillment. No matter how many possessions you acquire, the joy they bring is often fleeting. The thrill of buying something new can quickly wear off, leaving you feeling as though you need more to be truly satisfied. This focus on external markers of success can overshadow the more meaningful aspects of life that contribute to genuine happiness. Finding eternal happiness and balance is far more rewarding than chasing material wealth. True contentment comes from understanding your values, nurturing relationships, and pursuing passions that bring you joy. When you shift your focus from accumulating possessions to cultivating a fulfilling life, you discover a deeper, more lasting sense of success and satisfaction. How to spot bad financial advice and high fees. Lastly, having a BS detector, yes, a bad stuff detector, is essential for spotting questionable financial advice and excessive fees. This means being skeptical of advice that sounds too good to be true or promises guaranteed returns with little risk. If something seems overly simplistic or boasts about easy money, it's worth investigating further before taking action. To avoid falling for bad advice, look out for red flags like vague or exaggerated claims, high-pressure tactics, or advisors who can't clearly explain their fees and strategies. Genuine financial advice should be transparent, with clear explanations of how it works and why it's being recommended. If you feel unsure or pressured, don't hesitate to ask questions or seek a second opinion. When evaluating financial advisors, consider their qualifications, experience, and reputation. Check if they are certified and have a track record of honest, client-focused service. Research their background and look for reviews or testimonials from other clients. A credible advisor will have nothing to hide and should be willing to provide clear, honest answers to your questions. And that's a wrap on the financial tips that many experts might not share. If you found something useful in this video, please give it a thumbs up. Let us know what you learned in the comments and share this video with friends. If you're new to Luxo-Life, hit the subscribe button and the bell icon so you don't miss any of our updates. Thanks for watching, Luxo lovers, and see you in the next video.